Yes, we are live, Matt.
Well, welcome and thank you for joining us. I am Matthew Coyle and this is
Yin Coyle,
and together we are
Team Coyle.
and again we're glad to have you here and we have our question of the week and Ying has a doozy for us today.
Yep, Matt, I'm excited because this question relates to our daily living. This is from Ben. He was asking, we know, inflation rate. Everybody talking about this today. So how does this affect property value? And is it still a good investment? If you invest in real estate.
Okay. Well, Ben, that's an excellent question, and it's very topical. Inflation, as everyone knows, this past December, the 12-month change was 7%. That's measured by the Consumer Price Index. That's all items in the index, food, fuel, etc., everything. And we haven't seen that level of inflation in nearly 40 years.
Oh my God, 40 years, yeah.
I think the last date I have here is June '82. It was 7.1%, and we just recently published a report on that as well. So we'll have to make sure we put the blog into this YouTube video.
We're gonna make a link there.
Good.
So
obviously, it's big news, and it's been steadily rising. We also know that the Fed is interested in raising rates to fight inflation. Okay, and we had the same thing happen back in '82. When Ronald Reagan was president, right?
Right.
And Paul Volcker, I don't know if many people remember him, but he was the chairman of the Federal Reserve, and he was on a mission to burn inflation out of the economy. And the way you do that is you raise interest rate and you shrink the supply of money. Because inflation is all about the money supply, an increase in the supply of money that's greater than the output.
What was the interest rate by then? I forget what you said.
Well, I think in October '81 was the highest rate in 40 years. It was 18.45% for a 30-year fixed rate mortgage, and that's from Freddie Mac. It's a conventional conforming mortgage. So, when you're going to shop for your fixed rate mortgage, and if you have it and you got a high rate, and define high rate, if it's not going to be near 18, but lock in as long as you can. 30-year fixed or 15, whatever, but I would go for the longer term. You can do it fixed because you're never going to see rates this low again
because that was 6 times than right now.
Yeah, so I mean, whether you get 4 or 3.5%,
it's really historically low.
Low. I honestly, every penny counts. We as homeowners and investors understand that,
right.
But in terms of context, the money today is cheap. Okay, so locking in a 3.5 to 4% mortgage in that rate is just historically just very, very low.
So then back to Ben's question, what do you think about the real estate as an investment tool?
I think it's an excellent hedge against inflation, and it has outperformed other asset classes during an inflation period. I'm talking specifically bonds, which when interest rates go up, bond values go down, and interest rates for stocks, rising interest rate for stocks, which is caused by inflation, as we just said, is gonna. We're seeing in the market today. The stock market's all jittery. You're seeing these declines, these 500-point declines.
Wow.
Fear, greed. That's what drives the stock market. But again, the rates are real low. But these investment classes are generally underperformed relative to real estate. So maybe we should talk about why real estate is a good hedge against inflation.
That'd be great. Give us your opinion on that.
All right, so keep me on track here, okay? So there's really 3 reasons, all right? And some of them overlap, okay? And the first one is inflation allows landlords or investors in property who rent their property out the ability to raise their rents annually, because most property leases have
when you renew the lease, it will recheck the inflation rate.
Right, they're indexed to inflation, so you can adjust the rent every year. Okay, most leases are set up that way. So if I have 7% inflation, I can adjust it to 7%, my rent 7% higher. So obviously one offsets the other. Okay, so my expenses go up, my rent goes up. So as a homeowner or investor or a landlord, I'm protected.
Yeah, exactly. So what's number 2?
Good, thank you. Number 2 is new and existing houses are going to go up in value due to the high or the increase in construction costs, both labor and materials. So new houses, obviously, the more expensive it is, the higher the value is going to be. And then to replace existing houses, it's the same thought process. They're going to benefit from a higher inflation rate. So again, rising prices, rising costs, both labor and materials, is going to drive up that price of your house consistent with inflation.
Is that one of the reasons the housing value just keep going up and up right now?
It's one of the reasons, but we also have that supply-demand imbalance, which is a big factor.
Right. Yeah.
But this is going to put further pressure on it. And the first point I made, the ability to charge higher rents, the cash flows, the larger cash flows each month is going to lead to a higher valuation on your asset, whether it be stock, bond, or whatever.
Yeah, exactly. Okay, so now let's go to the last
third
reason.
one.
Yeah.
Okay. So the third one is inflation allows you to pay off your fixed rate debt, and this is why I was talking to lock into as long as you can to pay it off with cheaper dollars. Okay, you devalue your debt, and think of it this way. So let's say you have a $2,000 a month mortgage payment. Okay, and you have a fixed rate mortgage. That $2,000 is not going to change, but the value of the income, because your income is going to rise with inflation. If you work somewhere, you generally get a cost of living increase, and your salary or what your wages are going to go up. So you're going to be able to pay off your debt with cheaper dollars. So again, another hedge or benefit of inflation. So real estate actually just performs just better than other asset classes for those three reasons. And that's why a lot of people like investing in real estate. But the key is now to lock in, if you're a homeowner or an investor and you have a variable rate mortgage, start thinking about locking into a long-term fixed mortgage. Obviously, it depends on what your plans are. If you're going to move in the next year, I wouldn't worry about it. But if you're planning to stay there 5-10 years, I don't think we're going to be out of this period for quite some time. So
what does that affect the buyer today? So that means they need to.
Well, I think the answer is you're going to see a lot more buyers who might have been sitting on the fence get into the market and try and lock in at these low rates because rates are going up, and we've seen a number of how refinances go up every time there's fear that rates are going to go higher and so forth because everybody wants to get it in the best possible number. But again, historically, these rates are so low.
Right, compared to like the 3 versus 3.25, or even in the end of the year it goes to 4 maybe. Yeah, it's still very low.
Yeah, I think at year end it was below 3%, and I'm looking at the 30-year conventional. This is from Freddie Mac, but it's higher today, and it's gonna get higher throughout the year. So with the Fed doing its rate increases.
So what do you recommend to the sellers for today's
Well, I think sellers, look, if you got your finances in order and you have a fixed rate mortgage in place,
you're in a good position.
You're in a very good position. I think but if you're looking to sell, now might be the opportunity to sell and then go buy and lock in a low mortgage rate.
Yeah, I think the reason a lot of buyer trying to lock in the house, so it's good for you sit on the driver's seat, right? Sell your property.
Regardless whether it's a good market or bad market, sellers are always going to have the same issue: is if I sell, then I'm going to buy something,
right?
And everything is relative, so it's always going to be that case.
That's right. Yeah, that's great, Matt.
So did I do okay answering that question?
I think you did great.
Okay.
You want to give you a score or something?
No, I don't want to score.
Oh, okay.
No,
you don't want to have an A+ day or something.
If I got an A+, I'll take that, but I'm not taking anything more. So.
All right, great.
Well, listen, thank you very much for tuning in. We appreciate your questions. We enjoy them. And we're publishing a monthly newsletter, which is going to be on our website. It's also going to be including these links when we can.
Yeah, we're going to provide a link below. So
and, we'd love to hear your comments or feedback, or if you want to hear about any specific topic, I'd love to.
Call us, text us, or
Yeah, I
send email.
enjoy writing about it, and I enjoy talking about it because I used to be an economics major, and I just think it's all fascinating.
I even learned a lot from you, Matt.
Oh my God, I learn a lot from her every day. Well, thank you very much. Have a great day, and we'll talk soon. Bye-bye.
Bye-bye.